Alibaba just reported its latest earnings, and if you are holding Baba stock expecting a classic high margin cash cow value play, you might be looking at the wrong company. On the surface, Wall Street saw a fourth consecutive earnings miss and an aggressive margin squeeze, sending the stock tumbling pre-market. But beneath the headline noise lies one of the most aggressive corporate pivots in the modern tech history. Alibaba is quietly ditching its identity as just China e-commerce giant to go all in on hyperscale AI infrastructure. In this video, we are breaking down the exact numbers, analyzing what management revealed on the call, contrasting the booming AI bull case against the brutal e-commerce margin collapse, and answering the multi-billion-dollar question for long-term investors. Is Alibaba still a deep value stock, or is it officially an AI capital expenditure engine? Let's get right into the numbers. Let's start with the hard data, so you can see why the market had such a split reaction. For the quarter, Alibaba reported revenues 268.95 billion renminbi, or roughly 39.64 billion US dollars. That's a 9% year-over-year increase, topping consensus estimates. Adjusted EPS $1.26 per share, missing the consensus estimate of $1.85. Adjusted EBITDA 27.32 billion renminbi, representing a steep 30% drop year-over-year, and operating income 15.16 billion renminbi, plummeting 57% compared to the same period last year. So, why the disconnect? Why is top-line revenue beating expectation while operating profitability is getting cut in half? The short answer is aggressive capital reallocation. Alibaba is taking the cash flow generated by its legacy business and plowing billions directly into AI data centers, chips, proprietary large language models, and customer acquisition. This isn't an operational decay caused by falling demand. It is a calculated, deliberate sacrifice of short-term quarterly profits in exchange for high-performance AI infrastructure. When you listen to leadership, it becomes crystal clear that Alibaba views its future through the AI-first lens. CEO Eddie Yu made it explicit on a conference call, stating, "We delivered a strong quarter driven by improving commercialization of our full-stack AI capabilities. With our full-stack AI strategy, we have put Alibaba in a superior position to capture the substantial growth of demand for artificial intelligence and AI compute." Notice the phrasing full-stack AI capabilities. They are not just selling cloud storage. They are positioning themselves as a foundational compute layer for Asia. Meanwhile, CFO Toby addressed the margin question directly, noting that cloud segment revenue growth continued to accelerate, with quality earnings and operating leverage increasing EBITDA margins to 12%. As synergies across our core business deepen and AI monetization ramps up, we have greater strategic and financial flexibility to make disciplined and sustained investments. Management is sending an unmistakable message to the market. Do not expect expanding e-commerce margins right now. Expect massive investments into cloud and AI compute. To really understand where this company is headed, we have to look at the two radically opposing forces inside this earnings report. We have the first angle, the AI and cloud boom, which is the bull case, and frankly, it is impressive. First, you have accelerating cloud revenue. Alibaba Cloud's external revenue grew 45% year-over-year. We have 12 quarters of hypergrowth. AI-related product revenue delivered triple-digit growth for the 12th consecutive quarter. Massive ecosystem adoption. Alibaba's open-source Qwen model family is gaining massive traction globally. Apple is integrating Qwen models into Siri for Mac users in China, and Tesla has been testing Qwen for in-car voice recognition in its Chinese fleet. Then we have new enterprise tools. They just rolled up Work, an enterprise AI workforce agent designed to capture high margins corporate software budgets. Alibaba is rapidly proving that it owns the premier AI ecosystem across Asia. Then we have angle 2, the e-commerce and margin struggle, which is the bear case. Now, let's flip the coin to the bear case that has short-term investors running for the exits. We have operating margins collapse, an operating profit decline of 57% is severe for any mega cap company. We have the core e-commerce slowdown, customer management revenue, the core engine driven by Taobao and Tmall merchant fees fell 7% on paper, or rose a modest 1% when adjusted for accounting progress. Then we have intense competition. E-commerce in China is no longer a monopoly. Low price competition from platforms like Pinduoduo and ByteDance Douyin continues to force Alibaba to keep take rates low and spend aggressively on merchant subsidies. Then we have the earnings miss streak. This marks Alibaba's fourth straight EPS miss, testing the patience for institutional shareholders. Here is the single most important takeaway for long-term investors. The original value investing thesis for Alibaba is dead, and a new growth thesis has taken its place. For years, investors look at BABA through a classic Benjamin Graham or Charlie Munger value lens, a dominant retail monopoly with 30% plus operating margins, trading at a low single-digit PE ratio, returning capital via buybacks. That framework no longer fits. Alibaba is undergoing the exact same structural transformation that Amazon experienced between 2014 and 2018 and that Microsoft experienced under Satya Nadella. During a hyperscale cloud transition, you cannot optimize for near-term free cash flow. You must pour billions into capex, data centers, specialized silicon, and enterprise pipelines before competitors can catch up. If you own Alibaba expecting high near-term dividend yields or immediate margin expansion from Taobao, you will likely be disappointed. But if you value Alibaba as an infrastructure toll booth on the future of Asian artificial intelligence, this quarter shows that the foundational infrastructure thesis is accelerating at a 45% annually. So, if you are an investor with a 3 to 5 year horizon, this earnings report is not a sign of fundamental deterioration. It is the price of admission for structural transformation. Alibaba is actively using its still profitable retail business to fund an enterprise AI cloud engine that grew 45% this quarter. The margin pain today is the capital expenditure that builds tomorrow's competitive moat. What are your thoughts on Alibaba's transformation? Are you holding Baba for its AI cloud potential, or does the e-commerce margin compression make you cautious? Drop your thoughts in the comments below. If you found this breakdown insightful, hit that like button, subscribe for more institutional grade market analysis, and I'll see you in the next video.